Smart Digital Group, ticker SDM, exhibited a 40% intraday surge. On the surface, that suggests strength. In reality, it reflects a structurally fragile setup: low float, limited liquidity, and no institutional support. Based on current price action, float composition, and valuation metrics, I believe SDM presents a highly asymmetric short opportunity with a minimum downside target of 50%. Fundamentally, SDM is indefensible. A market cap of roughly $675 million, off trailing earnings of around 6 cents per share, gives it a PE ratio well over 330. There's no meaningful revenue growth, no institutional coverage, and no investor base to support this valuation. And it gets worse. More than 70% of the company's shares are held by insiders. That leaves a float of just 7.6 million shares in circulation. This isn't a real market. It's a curated float rotation. Now look at the price action. SDM opened at $17.61, ran to $29.38 intraday, and settled near $25. Volume? Just 918,000 shares, around 12% of the float. That's not institutional accumulation. That's synthetic volume. Insiders and market participants recycling shares to manufacture momentum and draw in late retail. The bid isn't real. The velocity isn't sustainable. And when that synthetic demand dries up, there's no natural buyer left underneath. And yet the borrow fee to short this stock is over 265% annualized. Most traders take that as a red flag. I see it as confirmation. It means borrowable shares are scarce, shorts are locked out, and only those who understand the risk are positioned. The cost of holding for a few days? Minimal compared to the potential return, because this isn't a 5% trade. I believe SDM has at least 50% downside. A drop to the $12 to $14 range is structurally justified and historically consistent with what happens when these IPO-style float traps unravel. We've seen it before. SKBLPHOELZMH. All the same pattern. Low float, no substance, sharp run-up, then a full unwind when volume thins out. So how am I approaching it? If the stock breaks $24.50 on weakness, I'm in. If $22.30 gives way, momentum is gone, and we're on a one-way path to the teens. My risk is defined above the 29 wick, but the trade doesn't need to get there. Just a stall, a failed bounce, and that volume evaporates. I'm not shorting because it's up. I'm shorting because I understand who's holding the float and how this movie ends. At this stage, there's no institutional defense, no catalyst, no fundamental reason this should be priced where it is. This isn't about valuation catching up. It's about an inflated narrative losing air. So here's the summary. We have a valuation north of 300x earnings, zero institutional interest, a 265% borrow fee keeping weak shorts out, a float of just 7.6 million, 70% locked by insiders, manufactured volume on a thin tape, and a visible 50% downside, minimum. This is one of the most actionable setups I've seen all quarter. The timing has to be right, but the thesis is clean. If this added value, subscribe for more breakdowns like this. IPO float traps, insider exits, and structural short setups with institutional clarity. Disclaimer: this video reflects my personal view of the setup. As always, shorting carries risk. Make your own decisions, manage your exposure, and trade responsibly. Thanks for watching. More soon.